Welcome to my channel. I'm glad you're here, especially for this very important and somewhat complex topic. My name is Darius, and as a private investor, I know firsthand how much taxes can cut into your profits. In today's video, we're going to take a deep dive into a topic that many of you are concerned about: the tax differences between investing in stocks as an individual and as a business. Should you consider setting up a limited liability company or other type of corporation to take advantage of potential tax benefits? Let's explore this together and find out what's best for your situation.
Insights for the informed investor.
Introduction to taxation in Germany. Before we get into the details, let's talk briefly about how taxes generally work in Germany when it comes to investing. In Germany, tax law can be quite complex, with various rules and exemptions that apply depending on your particular situation. It's therefore crucial to understand the basics before you make any investment decisions. Taxation as a private investor. Let's first look at the taxation of a private investor in detail. If you invest in shares as a private individual, all gains are subject to final withholding tax. This tax is 25%, which seems simple at first, but there are additional charges. The solidarity surcharge of 5.5% on the tax amount, and if applicable, church tax, depending on your religious denomination, are also levied. This can increase your effective tax rate to over 26% in some cases. Example: tax calculation for a private investor. Imagine you have bought shares worth 10,000 euros, and after a few years you decide to sell them for 15,000 euros. That's a nice profit of 5,000 euros. But be careful before you get too excited. Remember that you will have to pay tax on this profit. Let's break this down. Capital gains tax. 25% of 5,000 euros is 1,250 euros. Solidarity surcharge. 5.5% of 1,250 euros is 68.75 euros. Church tax. At a church tax rate of 8%, this would be an additional 100 euros. In total, you would therefore have to pay around 1,419 euros in taxes, leaving you with a net profit of around 3,581 euros. This is a considerable deduction from your profit. Loss set-off restrictions for private investors. Now let's talk about losses, because unfortunately not every investment makes a profit. As a private investor, the rules on offsetting losses are quite restrictive. You can only offset losses from share transactions against gains from share transactions. This means that if you have made losses on one share but have received dividends from another share, you cannot offset the loss against this dividend income. You must therefore pay tax on your dividends even if you have lost money elsewhere. Taxation as a company. The advantage of being a corporation. Now let's move on to how things look when you invest through a corporation, such as a limited liability company. Here, the tax landscape looks much more favorable for certain types of income. Tax treatment of capital gains for limited liability companies. One of the biggest advantages of investing through a limited liability company is the treatment of capital gains. For a limited liability company, 95% of gains from the sale of shares are tax-free. Only the remaining 5% is subject to corporation tax, which is currently 15%, plus the solidarity surcharge. Let's look at our earlier example again, but this time assuming that the investment was made through a limited liability company. The company makes the same profit of 5,000 euros. However, only 250 euros of this profit, i.e. 5%, is taxed at 15%, resulting in a tax burden of only 37.50 euros, plus a small solidarity surcharge. Compared to the 1,419 euros that a private investor would have to pay, this is a considerable difference. Dividend income and corporate taxation. Another aspect concerns dividend income. We need to differentiate here. If a limited liability company receives dividends from a shareholding of at least 10% in another company, 95% of these dividends are generally tax-free. This means that here, too, only 5% of the dividends are taxed at the corporation tax rate of 15%. However, if the shareholding is less than 10%, the dividends are fully taxable, just like for a private investor. This regulation makes it particularly interesting for a limited liability company to hold larger shareholdings in companies in order to benefit from the tax exemption. You lose this advantage for smaller holdings that are below the 10% threshold. Effective loss management for companies. When it comes to managing losses, corporations have even more advantages. Unlike private investors, a limited company can offset losses from the sale of shares against profits from other business activities. This flexibility can be crucial in years when the stock market is not performing well, as you can reduce your overall tax burden by offsetting bad investments against income from other parts of your business. Considerations for setting up a limited liability company. With all these benefits, you may be asking yourself, so why doesn't everyone invest through a limited liability company? Well, it's not quite that simple. Setting up and running a limited liability company comes with its own costs and administrative overheads, initial costs, and capital requirements. First, there is the issue of capital. In Germany, you need to raise at least 25,000 euros as share capital to set up a limited liability company. This is a considerable sum, especially if you are a smaller investor. Although only half of this amount needs to be paid in immediately, there is still a considerable financial outlay. Ongoing administrative costs. Then there are the ongoing costs. Running a limited liability company requires regular bookkeeping, the preparation of annual accounts, and the completion of tax returns. These tasks usually require professional support, which can add up. Bookkeeping costs, annual audits, and tax consultancy costs can easily amount to several thousand euros per year. Weighing up the costs against the benefits. So, is it worth it? The answer depends on your specific situation. If you're investing large sums of money and expecting significant gains, the tax savings could outweigh the costs. However, if you're a smaller investor with a modest portfolio, the running and setup costs of a limited company could outweigh the tax benefits. It's a balancing act that requires careful consideration. Pitfalls to be aware of. Although the tax advantages of a limited liability company are obvious, there are some potential pitfalls to be aware of. One important point is that profits must remain in the limited company if they are to benefit from the lower tax rates. Once you wish to distribute profits privately as dividends, additional tax will be due, which can significantly reduce the tax benefit. Risk of double taxation. This brings us to the concept of double taxation. When a limited company makes a profit, it pays corporation tax on it. If you then distribute that profit to yourself as a dividend, you also pay capital gains tax on it. This double taxation may negate the benefits of the lower rate of corporation tax, especially if you need to take money out of the company regularly. Strategic investment objectives. Before you make a decision, it is important to clearly define your investment objectives. Are you investing for the long term, with no immediate need to capitalize on your gains? Or do you need regular income from your investments? Your answers to these questions will strongly influence whether setting up a limited liability company is the right decision for you. Practical examples and scenarios. To give you a better understanding, let's look at some practical examples and scenarios. Example 1. The long-term investor. Suppose you are a long-term investor with a portfolio of high-dividend stocks. You plan to reinvest your dividends and only withdraw your profits when you retire. In this case, a limited liability company could be very beneficial. You could use the tax advantages of the limited liability company to grow your assets strongly over the years and only access the money later if necessary. Example 2. The short-term trader. In contrast, if you are more of a trader who regularly realizes profits and wants to take advantage of them, the additional costs and double taxation of a limited liability company could negate the benefits of the tax breaks. In this case, it might make more sense to continue to act as a private investor. Conclusion and recommendations. In summary, investing through a corporation such as a limited liability company in Germany can offer significant tax advantages. particularly for those with larger investment portfolios or long-term strategies. However, it is not a one-size-fits-all solution. The decision to set up a limited liability company depends on your individual financial situation, your investment objectives, and your willingness to take on the additional administrative burden. I strongly recommend seeking professional tax advice tailored to your specific circumstances before making a decision. A tax advisor can help you navigate the complexities of German tax law and determine whether a limited liability company is the right choice for your investment strategy. If you found this video helpful, give the video a like, subscribe to the channel, and activate the bell so you don't miss any more videos. Your support helps me continue to create content like this. Thanks for watching and see you in the next video.